With SBI and BOB done over the weekend, all the banking and NBFC results of importance are done, and it is time to do an overview of the Q2 numbers for the BFSI space. For exactly that, I have with me Suresh Ganapathy, banking analyst at Macquarie Capital Securities. Suresh, thank you very much for your time. Let me first start with the big boy. State Bank, the market is not reacted very positively, but it appears to have done well on asset quality and on margins. I mean, not fallen as much as one feared. What would you say? You don't think it's a spotless show?
Yeah, but Latha, the ROEs are down, right? QQ. Yeah. So you can very clearly see that the fundamental performance peaked out last quarter, and now you're seeing ROEs coming down for some reason or the other, right? So obviously this quarter, the one-off wage hike-related provisions brought down the ROA, but credit cost was also unsustainably low, right? They had some write-backs. So next quarter, you're not going to maintain the same level of credit cost, even though OPEX will also not be at the same level. So the key messaging that you can drive across from both SBI as well as Bank of Baroda results is the fact that ROEs have peaked, and you're only going to see them coming down in subsequent quarters as cost of funds catches up, and then margins further go down, and also credit costs also has to sequentially pick up. The current level of recoveries are clearly not sustainable in subsequent quarters.
Okay, then let me come to the non-SBI PSU banks. BOB, actually, I don't think the numbers were all that bad, but the markets reacted negatively. Canada Bank, I remember, reported strong numbers. So your take on the non-SBI PSU banks?
Look, I think, Latha, one good part about them was that their margin compression was not as high as compared to the private sector banks which reported the numbers, right? But that is also because the margins never necessarily went up as much as the other private sector banks last year, right? So to that extent, the relative margin compression has been modest, and also they're guiding for more modest compression in subsequent quarters. So that's something where the PSU banks have definitely done better. Now, going forward, I think, Latha, one thing we have to really factor in, which the market is currently definitely not factoring in, is the ECL related charges, right? So just a matter of time, the final guidelines come through maybe in another 6 months' time, and then you will actually see a big bump up in provisioning across the public sector banks because of ECL. Note that unlike private sector banks, none of them carry any buffers in our view, and to a large extent. So to that extent, obviously, you're going to see further pickup in credit cost, if not this year, at least beginning of next year, when they start making ECL related provisions, which can obviously bring down their ROA.
Okay, well, so for the viewers, ECL is expected credit loss, the new kind of provisions which RBI will bring. Okay, so Suresh, to come back to the question, therefore, what are your buys in the PSU banking set? Or have you changed the price targets for any?
No, so we do have a neutral on BOB and buy on SBI. But having said that, generally as an asset class, I think it is time to book profits. They have had an excellent rally. I think the trade, Latha, last 12 to 18 months was very clearly to move from high quality private sector banks to low quality private sector banks, or for that matter, PSUs and NBFCs. I think we are nearing the end of that trade. If I were to really take, you could see the stress which is seen in the personal loans. Yes, it's not widespread, and we will discuss that a bit later. But you could see some signs of stress emerging in the system. And if at all there is a rate cut in FY25, the margins have further downside. So to that extent, I would really see a strategy where you move from the low quality ones to the higher quality private sector banks.
No, wait, you spoke about unsecured loans. I'm not later. It's a priority question for me. Let's discuss it up front. Like your report, CNBC TV18 also reported that under 50,000 rupee loans are showing higher NPAs. And, you know, Chola admitted to it in the conference call. Now, where will this unsecured small loans hit first? Will it hit the NBFCs first?
Yeah, so if you look at even Chola's numbers, and if you even look at, for example, data which has come out from CIBIL TransUnion, it's all concentrated on the lower ticket size personal loan segment, right? So even in Chola, the problem is with their partnership with Fintechs, where the NPLs are high. So if you look at on a lag basis, the numbers is in double digit, more than 10% as per our calculations. So, and even CIBIL report shows that the less than 50,000 personal loan NPLs is almost 4 to 5 times in percentage terms higher compared to the normal personal loans category. So as we have been talking about that, the stress will emerge from the fintechs onto the NBFCs and also to the banks who have a larger tie-up with the fintechs and are generating growth. I don't want to take specific names because we don't really cover many of them, but it is through these partnerships where the NPLs will first show up and then organically into their own numbers, and finally it moves on to the large private sector banks. But we are quite some time away. I think, Latha, the bigger issue in my opinion is the cross leveraging which is happening, right? So if the guy has more than 4 loans, though he may be defaulting on the less than 50,000 rupee loans, what happens if he has taken a home loan or a car loan from a bank or an NBFC, and how his behavior will spill on to the other kind of loans is a big question mark. And right now, we really don't know how the risk will play out, the contagion risk will play out in those segments.
No, that is a problem. I know some bankers who told me that they are worried that small personal loans are being taken to play in the stock market, So there is that fear. But let me come to the NBFC since you referred to Chola as well. Now, you remember Shriram got upgraded after the numbers. What are your best buys in the NBFC space after the Q2 numbers?
So actually, we also like Shriram, and we also have been pretty bullish on the name because there is a valuation and a risk reward which is favorable at this point in time. So we have to be a bit selective here, Latha, because on one hand, you would believe a stock like a Bajaj Finance on Chola, though fundamentally in a good position. Yes, Chola has had its own share of problems, but they still have actually managed to protect their ROA despite this personal loans issue. And BAF, of course, has been doing pretty well. So I guess, and the initial feedback here is the festive season is so far holding up pretty well. So I guess as long as growth remains, and one of the reasons why Shriram has done very well and maybe other brokers have also upgraded is because they upped their growth guidance, right? So I think the NBFC still remain a big growth place. And as long as you see growth sustaining, which we see at least for the near term that happening, they still remain preferable place. The call here is how long is this growth sustainable heading into FY25, and therefore relatively between banks and NBFCs from a longer term perspective, we still prefer banks because the risk reward is a bit more skewed towards the banks than towards the NBFCs.
So the buys what are your buys in the NBFC space? Shriram and what?
Well, recently upgraded BAF, so BAF is also a buy, and Chola. So we're sticking with high quality ones, and Shriram obviously because of the valuation arbitrage which is there.
What about the smaller NBFCs? You grow, I remember, Credit Access Grameen, Home First, all of them reported very good numbers. Do you cover any of these? Any thoughts?
No, so we don't cover any of these smaller NBFCs, but look, I think one has to understand that the credit cycle has been way too favorable, right? So that has happened, that has resulted in them being in a position to grow. Even the, let me put it this way, the bottom of the pyramid customers or the affordable housing customers, let's put it that way, those segments pretty well. I think we are almost nearing towards the peak of the credit cycle, Latha. I mean, my view here is that at least some normalization should happen heading into FY25. We are not looking at a blowout kind of a scenario which happened in the corporate loans 4 or 5 years ago, because those are large, chunkier loans. These loans are far more granular. So to that extent, the risk is much more diversified. But the challenge that I have right now here and looking at all these names, or for that matter in general, the sector here is the market is not even factoring in a normalization of the credit cycle, which is where I think the risk lies in, because you just cannot accept such kind of a good scenario lasting for extended period of time.
Yeah, there could be a valuation argument there. Now let me come to the most favored space, the good old space, private banks. Among them, the ICICIs, the Axis, the HDFC banks, what is your pecking order of buys?
Look, I think across the board, growth has still been strong. Yes, there has been a little bit amount of margin compression, but still the first half is looking better than the previous year first half. So still end up ending, even if you have a catch up of cost of funds for the next couple of quarters. And we are quite some time away to even argue for these private sector banks for some kind of a credit normalization. So things still remain pretty strong there, Latha, from an outlook standpoint. And look at it in this way, right? I think one has to take a big call whether there is going to be a significant reduction in ROE for the subsequent years, right? So we still believe these guys are in a position to generate 15-16% ROE, while one can argue that the multiples may have very limited room for further expanding, but you will still have a stable book value growth, a stable ROE, which the book value obviously is a function of ROE. And I don't see a risk to that, mainly because I don't see a risk of blowing up of credit costs. You know that all these private sector banks, the large ones, all of them carry still contingent buffers. So if a guideline like an ECL comes through, or we are going to see some stress in the personal loan segment, all of them have enough cushion to manage their earnings and report a decent ROE. And therefore, as I said right at the start of my conversation, the private sector banks are still better placed. And within that, we do like HDFC, ICICI, and IndusInd as our top picks in the sector.
Oh, IndusInd. Okay. I don't think we'll have time to discuss that because we're running out of time. I want to discuss the Fintechs. Paytm, PB Fintech, very good numbers, I thought. Anything you favor in this? Or even here, would you say the best is behind us?
We would be... No, so look, we would be definitely cautious. I think you have to look at it in this way that clearly a lot of over leveraging on the consumer side has happened through the fintech space. We're not saying all of them are like that, but a reasonable proportion would be like that. Even if you look at the RBI data or the CIBIL data, the fintech NPAs are at a higher rate. We still have to see whether pricing mechanisms have evolved enough for them to price these higher loss rates into their overall portfolio. And look at Paytm's volume numbers, right? Personal loan volume numbers decline QOQ. So there's some stress evident. PB Fintech still continue to report a higher loss there, of course, because of higher expenses this quarter. So we'll have to see actually the path towards profitability, and still that still remains a bit iffy for me related to the expectations, and therefore I would still be a bit more guarded on that space.
Okay. Take your point, I mean, about the warnings for hereafter. But Suresh, Diwali week, pre-Diwali week starts. Here's wishing you a very happy Diwali and everyone at home as well.